Hi, I'm Greg Weldon, and I'm your host for Money Markets and New Age Investing. This is episode number 9. It's going to be a little bit of a departure from what we've done in the past, which is really top-down macro monetary global overview, and then a bottom-up kind of technical seat-of-the-pants trading / investing underview, and trying to get all of this to meld together in the middle to come up with investment strategies and ideas here. In terms of ways to try and keep pace with the debasement and devaluation of the purchasing power of paper currencies, every single one of which on this planet right now is being debased and is devaluing right now as we speak relative to an ounce of gold. We're going to talk about that in a few minutes. But what we're going to do here for the next 3 episodes, it's like a little end of summer series here. When I used to be at the beach for July and August at the Jersey Shore, Long Beach Island, when I was a kid, every summer growing up, we'd be down at the beach for 2 months. And the first thing I would do, and I get so excited when I get there and get on my bike and go to the bookstore and buy books. So in this case, I just kind of picked up couple of old books and decided I'm going to do a little summer reading. One new book in particular got me started. But Market Wizards is one I've read so many times, it's not even funny. Chapter after chapter, over and over. Market Wizards, written by Jack Schwager, who was at Pru, was at Commodity Corp. Brilliant mind. Brilliant, absolutely genius mind on Mr. Schwager. And he started doing interviews with all the great traders. So Market Wizards, never heard of it? You must buy it. It's another, there's 2 versions. There's a whole bunch of versions now, but, 2 original Market Wizards. And then there's also the new Money Masters. I think John Train. Why does that name sound familiar as the author? I'll double check that at some point and post it on Twitter. But this is a thing where, learning from these great traders and the lessons, because I was on an interview on Thursday, and I was asked, what do you see as different from the markets back in the 80s and 90s, and what do you see as the same? And I say, well, there's a lot of differences. The thing that's the same is human nature. People, hope, greed, and fear, the whole kind of dynamic. Now, human behavior has become more volatile. This is part of the polarization and electronification of the planet, just in terms of, the celestial astronomy, astrophysics going on. But in that context, some lessons reverberate and are timeless. And the lessons in this book are must-haves in your toolkit to be successful in investing or trading or whatever kind of, melding of those 2 things you end up doing. And I could talk about the difference between investing and trading for a long time. I call myself a trader, but I'm really an investor. We want long-term positions. I'm not in and out. I'm not scalping the market. I want trends. The meat of the money made in markets is in long-term trends and the quick reversal type crashes or spikes on supply-demand, imbalances. So, starting with number 1 today, Market Wizards Speak series from the Money Markets and New Age Investing series is the Market Wizards Speak series, part 1 of 3 parts. And today we do Ed Seykota. Probably never heard of him. Most people listening, I would bet 90%, if not 95%, do not know who Ed Seykota is. He is the original. He developed the very first program trading algorithm. All right. He went to MIT, where he graduated with an electrical engineering degree. He went on to go to the Sloan School. He then ended up at Payne Weber, where he met Michael Marcus from Commodity Corp, thus the link to Commodity Corp. Commodity Corp was a place started in the 70s by a couple of gentlemen, Amos Husstetter and Helmut Weimer, I think are the names. But in the context of, this was a think tank / money management place that would, basically promote trading as like an art, because it is. It's not something, you have talent for it, but you got to develop that talent. And that's what this place was designed to do, in addition to, being a think tank of great minds. And they only hired the best guys. In terms of Commodity Corp, Michael Marcus, Ed Seykota, those are the first 2 names. But this is where people got their start, such as Bruce Kovner, Grenville Craig, Paul Tudor Jones, and then my boss, Louis Bacon, from Moore Capital Management. Now, I met Louis when he was a broker at Lehman Brothers. And he had money from Commodity Corp. Lewis Tudor Jones had money from Commodity Corp. They basically kind of grew up together. This also kind of goes hand in hand with, who's the other? I can't remember the name. One of the other big hitters in New York. They're all kind of uncles and cousins and so on and so forth from North Carolina. You know, Tudor Jones, of course, came up in the cotton trade. If you don't know the story, if you don't know who Tudor Jones is, perhaps the greatest trader of all time, although I would rank Lewis maybe up there with him, if not a bit above him in terms of more recent performance. Lewis shut his fund down, I believe, in 2018, maybe earlier. Tudor Jones is still going. But this was a place of great minds. When I was at Commodity Corp, I was there for 2 years. I had a 62% after-fee return over that 2-year period with an 11% max drawdown and was ranked second top, risk-adjusted trader in the program. While I was there, they brought in Ed Seykota to coach us. And it's really interesting because how he is in this book is exactly how he was in person. I mean, intelligence beyond almost an ability to have a regular conversation with the guy, even though he was very humble, down to earth, and funny. He had a great sense of humor, too. So he was kind of easy to talk to and yet really hard to talk to, if you know what I mean. So I want to read, and I did. I contacted Jack last weekend. I said, Jack, do you mind if I read your book on the air, as if I'm interviewing these people? He said, go right ahead. I'm also hoping, and I haven't asked him yet, that he can come on at the end, and maybe we'll do a little quick interview. I'm not one on interviewing people. This is more about, me sharing my views, my thoughts, and my experiences. But I think this really is something that will be valuable because, we started this to give you the macro idea, but also to try and help people, learn how to do this themselves. And you really can become your own hedge fund, your own CTA. With ETFs now, we do the portfolio playbook that works there, and I'm not trying to sell you, but, there are instruments out there that can help you do this. But it really is up to you, and you have to devote the time. You have to have the passion for it. You have to learn. You're going to have to make mistakes. So let's get to Ed Seykota. Here's the questions and answers between Jack Schwager and Ed Seykota in Market Wizards. Jack Schwager asks, what are the elements of good trading? Now, Ed Seykota was the master of simplifying his answers. I mean, he really was. What are the elements of good trading? Well, the elements of good trading are cutting losses, and cutting losses. If you follow these 3 rules, you just might have a chance to be successful. That is 100% true. I could not agree more. Cutting losses, the biggest, single most important thing. And frankly, one of the easiest things to do, as you'll see as we go forward in this Q&A. All right, Jack Schwager asks, how do you handle a losing streak? Ed replies, I handle losing streaks by trimming down my activity. I wait it out. I trying to trade during a losing streak is emotionally devastating. Trying to play catch up is lethal. 100% from experience can tell you. This is exactly what I do. When you have a losing streak, it's not working. And the way I trade, it's both bottom-up technical. I want to execute it technically and mathematically. But the idea for the trade comes from the fundamentals, from the macro, from the monetary, from whatever it might be, psychological imbalances, demand-side dynamics, whatever it might be the theme. I trade it technically. Get the theme, wait for the technicals to confirm the trend, and then trade it mathematically. And in this sense, I always put a stop in the second I place a market order to buy or sell something. And I always use market orders to buy and sell something almost 98% of the time. All right. Maybe in a thin market, I might use a limit order. That's dangerous. I don't do it often. And sometimes I'll use a stop order to get into a position in case I'm out of the office or sleeping or whatever it might be, in the 4 hours of sleep a night I get. So in that context, almost by definition, if you're in a drawdown, you should be having less and less leverage because you're wrong and you're getting out of losing trades and you're waiting for a higher degree of confidence. Because what you do find, and this happens to everybody, it certainly happens to me, and I'm aware of it, so I'm able to rein it in real quickly now, all right, which is when you're on a winning streak, all right, I hate those terms, winning and losing. This is not about winning and losing. It's about making money and not losing money. Okay, so that's two different things from, winning and losing, because you're conditioned to have to win at all costs, and that gets people in trouble. The conditioning here is like a baseball player. If you hit the ball 3 out of 10 times, you can be a superstar and make millions of dollars. Same thing here. You can be right 4 or 5 out of 10 times, and if you're making 2.5 to 4 or 5 times as much as your winners as your losers, you're going to be wildly successful. Then how you measure leverage and your per trade risk against your starting capital will determine your risk of ruin. All right. So I always have a stop. My stop is re-engineered the backwards. In other words, I want to risk our managed accounts our $1 million minimum. And it's because these markets are so huge. I mean, we had a $50 move in gold the other day. That's half of 1% on $1 million. My per trade risk is 0.4, 0.5. I can't have a per trade risk in a single day. So, some of this volatility dynamic has really widened the stops. So we have to have a large minimum to make sure the risk overlay works, because it's the most important thing. Without the risk overlay and the math and following it in the most disciplined way, where I actually have little cards, that's just me from the old commodities exchange floor, where we used to write up tickets, and I had a big book of tickets and paper flying everywhere. It's kind of like my desk. I use index cards. Every position has an index card that tells me when I did it, what I did it, when the stop was, what it's moved to, and what the risk is. I figure out the risk right away to my stop. So here's where I'm buying it. Here's my stop. How much money is that? And then I fit it into the position size defined by the amount of money I'm willing to lose, which is defined on where the technical stop is that tells me I'm wrong. Not I'm willing to lose this much money, so that's where my stop is. No, bad way to go about it. You put the stop where it's technically meaningful against the position, and then figure out how much money that represents, and then apply the position size accordingly to meet your minimum, or rather your maximum per trade risk. So we'll say that again. I handle losing streaks, this is at Dakota, by trimming down my activity. I wait it out. You do. You wait it out. And I'll tell you, now I tend to be early, which means I know my drawdowns tend to be in the beginning of bigger trends that ultimately play out. And so our recovery time tends to be really fast, and that works into my per trade risk. I want to give myself enough, rope to potentially be in a position 3 or 4 times. If it's really 3, then that's pretty much I got to be wrong instead of early, because, those are two different things. Being early doesn't mean you're wrong, but it could mean you lose enough money where it doesn't matter whether you're right or wrong. Again, it's not about being right or wrong. It's about making money and not losing money. All right, so let's get back to my interview here with Ed Dakota vis-a-vis Jack Schwager. We're talking about two of the greats in this industry here. I'm really honored that Jack has allowed me to do this. So talking about if you're a systems trader, okay, since you're primarily a systems trader, wouldn't following a system imply no changes in trading activity during losing periods? Well, then he answers, well, psychologically, I alter my activity depending on performance. I tend to be more aggressive after I've been winning and less so after losses. These tendencies have worked out okay. By contrast, a costly tendency is to get emotional over a loss and then try and get even with a bigger position. And man, I've seen people do that, and I've seen great traders do that. This is almost a lesson like you have to learn for yourself. But it's true. I mean, it is by nature, okay, the performance makes you less aggressive. I mean, of course it does. But at the same time, understanding your methodology can't be called into question because of a losing streak. And then you start to wonder, is something changed in the markets that's fundamentally affecting my technical indicators or the way I'm looking at this from a macro monetary perspective? What am I missing? This is what I do every day. I don't sit there and pontificate. I sit there, the first thing I do is, what are the reasons I could be wrong? Show me all the reasons I could be wrong, then show me all the reasons why I think I'm right, and I'll make a judgment. And that's a day-by-day thing. So here's another question. Do you decide, so in the first part we talked about cutting your losses, all right? Then we talked about having a drawdown. Then we talked about the risk management of your stops, all right? We're going to keep going, okay? In terms of, losses, okay? Do you decide where you're getting out before you get in on a trade? And Ed Dakota says, I set the protective stops the same time I enter the trade. I normally move the stops to lock in a profit as the trend continues. Sometimes I take a profit when the market gets wild. This usually doesn't get me out any better than waiting for my stops to close into the price, but it cuts down on the volatility of the portfolio. Now, I know exactly what he's talking about. I mean, trailing stops is the way to go, but getting out of a winning position, of a profitable position, again, I hate that phrase winning, of a profitable position is the hardest single thing to do in this endeavor. By far, every trader I've ever spoken to has agreed with that. Getting out of a profitable position is the hardest decision to make because there's no hard and fast rules. I do it a lot by discretion based on patterns I've seen in terms of the psychology of the market. When it gets frothy, when it gets chaotic, when it gets really greedy and out of control, and all of a sudden, you might snap away all those profits from somebody, and you see the psychology, in the markets play out very quickly. I've seen it so many times that I tend to recognize it early. Again, I've said before on this podcast, one of my just natural talents is pattern recognition and connecting the dots of little things that don't seem to matter. It's what helps me play poker too, plus having a mathematical and scientifically, skewed mind. Math to me just comes naturally. But to whatever extent, Ed Seykota puts his protective stops in the same time he enters the trade. I know where my stop is before I even put the trade in because I have to figure out how many contracts I can buy by determining where the stop is and then re-engineering backwards the math to find out how many contracts I can buy. All right, if it's a $100 stop, then I can buy 15 contracts. If it's a $200 stop, I can buy 7.5. Let's round it down. Always round down, if you follow what I'm saying. All right, so in terms of kind of what's really important here too is like breaking the rules. Okay, what are the trading rules you live by? Says Jack Schwager, asking the question. Ed Seykota replies, cut losses, ride winners, keep bets small, follow the rules without question, but know when to break the rules. So Jack presses him on this, all right? Your last two rules are cute because they're contradictory. Seriously now, which do you believe, follow the rules or know when to break the rules? And I could not agree more with his answer. I believe both. Mostly I follow the rules, but I find a new rule which breaks and then replaces the previous rule. And sometimes I get to a personal break point too. And when that happens, I just get out of the markets altogether and take a day. And I've done that too. I mean, that's sometimes, it's on both sides. You could be losing and get frustrated and think what's going on and it's not playing out in the prices. And you think the people in the market are insane for, taking the positions they're taking. You got to step back sometimes and just get out of everything and take a fresh approach the next day. This is a psychological war. We talk about things that people do for a living that are journeys of self-knowledge. That's what this is. That's what this is. And that comes down to our next point. Okay. Because, bottom line is, this is you. I mean, you're facing your own psychology. And I think that a lot of people aren't honest with themselves about their own psychology. They want to admit their own faults, their own flaws. They won't admit the things that traumatized them when they were younger out of shame or whatever, ego or machism or, macho, when you're this macho ego sometimes. So to whatever extent, you have to battle those things when you're a trader because, you have to devoid yourself of these emotions and be disciplined, follow the methodology. And most methodologies I know don't include emotions. I mean, they just don't. All right. So, let's get to the personality question, all right? Jack Schwager asks Ed Seykota, and this is a response to, again, the rules. Okay, so talking about the rules. One more quick comment from Ed on the rules. So he says, I don't think traders can follow rules for very long unless the rules reflect their own style. Eventually, a breaking point is reached and the trader has to quit or change or find a new set of rules he can follow. This seems to be part of the process of evolution and growth of a trader. I couldn't agree more. What kind of trader are you? How attached do you want to be? What are your talents in doing this? What are your strengths? What are your weaknesses? And putting yourself in a position where your methodology plays on your strengths because you have to believe in it the most during a drawdown. And the second you abandon your methodology because of one drawdown, you're not built for this business. I mean, there's drawdowns. It's ebb and flow. It's a probability curve. You're not getting all these profits without drawdowns. And most of the drawdowns take place when you're taking profits. So it's a natural kind of flow. So here we get to kind of psychology. Jack Schwager asks, how important is gut feel? Great question, especially when you're at the poker table, let me tell you. Ed Secoda replies, gut feel is important. If ignored, it can come out in subtle ways by coloring your logic. Man, that's psychology, at a higher level for sure. I mean, that's what kind of everyone does with their triggers. They don't deal with their issues, their trauma, whatever, and it comes out in unhealthy ways when you're triggered. I mean, I know this. I did a lot of work on this myself. I mean, it's, I think everyone needs to do that because everyone has trauma. Anyway, it can be dealt with through meditation and reflection to determine what's behind it. If it persists, it might be valuable to have subconscious analysis. Otherwise, it's dangerous. It becomes a dangerous sublimation of inner desires for excitement and does not reflect market conditions. Be sensitive to the subtle differences between intuition and intuition. And Ed Secoda used to love to come up with these little quips like that, okay? Be careful about follow your intuition, not your intuition. WISHING. Now, this is an interesting dynamic here. They ask him, what's your worst year? And he says 1980. And, he's talking about, having a big decline in the markets, and then he thought it would keep going, and it didn't. And I had the same experience in 2009. I was shocked that they came in and I wrote that they're going to bail out, whatever you have when you have a debt deflation. But the way they did it and the quickness with which they did it and the force with which they did it did catch me off guard. So we kept trying to kind of sell the market, into April, maybe even early May in 2009, which, was the trend. The trend had extended so far that it reversed before we really kind of realized it. And so you learn from these things too. And that really was a big help for me in terms of being short during the pandemic in the stock market and getting out early and really well because of my experience in 2009. Now here's a good one because this is so Ed Secoda. All right. Jack Schwager asks, what's the most important advice you can give your average trader? The average trader should find a superior trader and give his money to him to do his trading for him, and then go find something he really loves to do. You might want to listen up on that one. It's really good advice because this is hard to do, and you have to be passionate. I mean, I'm just so happy I still have passion to do this after 40 years. There's not a lot of people still left in the business that I knew when I started. I mean, they dropped out or went on and did something else or went bankrupt or who knows. Now, talking about the bad year. So in terms of kind of talent, all right, this is a great question. Jack Schwager asks, do great traders have a special talent for trading? And what's the difference between talent and work in trading success? Now, first of all, he says the difference between talent and work is I don't know where one starts and the other stops. So they're connected. But when you talk about do great traders have special talent for trading, Ed Secoda answers, good traders have a special talent for trading just as good musicians and athletes have talents for their fields. Great traders are the ones absorbed by the talent. They don't have the talent has them. And that's really interesting, developing that talent, knowing you have it, but without being egotistical about it. And then finally, how much of a role does luck play in trading success? Luck plays an enormous role in trading success, says Ed. Some people were lucky enough to have been born smart, where others were even smarter and got born lucky. So Ed Secoda, it's classic. I mean, again, luck plays a role. Some people are lucky enough to be born smart. Others are even smarter by being born lucky. In other words, luck matters to some degree, But what's interesting is, lucks or smarts or a gift are words that indicate an attitudinal proclivity for mastery. That's from Ed Secoda. In other words, I think most good traders have a little extra spark about trading. Some people are natural musicians, painters, or salesmen. I think it's difficult to acquire talent for trading. However, if it's already there, it can be discovered and developed. And I think that really, says a lot. So I think that that's an interesting, insight. I agree with every single thing that he says in this book. And again, I think the book is great. We're going to do some more interviews over the next couple of podcasts. But to talk about where we are right now with this week, all right, what we had over the last 2 weeks, pretty much what we said the last podcast. I mean, the economy continues to crumble. We see the labor market is now under bigger pressure. The unemployment rate's up. The U6, which is the total unemployment rate, is at 7.7. It rose 0.6% in June alone, from 7.1 to 7.7. The number of unemployed is huge. The jobs are part-time. Okay, you can whittle it down. They're government jobs or they're part-time jobs. Full-time jobs are down 1.5 million over the last year. All right, wages are not going up. Savings are still depleted. You know, consumer delinquencies on consumer credit cards is through the roof again. I mean, so nothing's changed except for the negative. ISM service data last week was horrible. Horrible. New orders, backlog of orders, and new export orders all crashed. And this is really bad number. Then you get the employment report. You have a new high 2 weeks ago in the number of people receiving unemployment benefits. The CPI comes out. It was actually below 3. You know, they're talking about 3%, 3%, 3%. Well, you know, they take this out to the 1/1000th of a point. The actual CPI, 2.975. So it was below 3. So, of course, with a 5.5 Fed funds rate and a CPI below 3 and a PCE below 2.5, the Fed should be cutting rates just to stay tight instead of becoming even tighter, which is happening. The decline in inflation is making Fed policy tighter because it leaves a higher real rate, the inflation adjusted rate. You take the Fed funds rate minus inflation, that's your real interest rate. All right. A real interest rate of 2.5 to 3%, which is what it is right now, is punitively tight. It will continue to strangle the economy. And Powell finally says on Capitol Hill, this was the biggest thing we've seen in months, when he equated risk in the labor market is just as much as risk of higher inflation. That's key. Everyone rushes to believe now we're going to get an interest rate cut, which we will. We've already probably priced in too much to the futures market, but that's okay. But what's interesting here is the action in the stock market. Because what you've had is this 7 stocks responsible for all the gains. I mean, those 7 stocks up 48% year to date, while the rest of the 493 stocks up 7%. The Russell was actually down for the year at one point a week ago. Since Powell spoke and the CPI number came out, the equal weight S&P soared, meaning they're taking out of the big cap tech Magnificent 7, and rotating it down into small cap, into some growth, into some value. It's coming back into the market. But this is a bad sign. When this happens, you know, it's not the kind of rotation that would normally be what you might call healthy. So this is number one, because you're not going to get the profit growth there, and it's going to cause a bigger liquidation is the fear here. Certainly something I've been talking about for a while. I mean, in the research, I've been talking, this is a liquidation setup, this is a long liquidation setup, this is a profit-taking setup, and that's what you got. Taking profits, putting it into safer, underperforming dynamics. So that's interesting. One I'll give you from our portfolio playbook that we've been waiting for, and I talked about it on the show, all right, the XLRE, the real estate ETF. I said when the Fed does give us the telegraph point that they're going to be moving at some point, probably September, that the MBB, which is the mortgage bond ETF, and the XLRE, the real estate ETF, would probably explode. That happened this week in both of them. The XLRE exploded. Most of the stocks in there are now flashing bullish signs. Real estate is like already on fire within a week. The other thing to look at is gold. I just did a massive special on gold. If you want a copy, shoot me an email, Greg Weldon, Weldon at weldononline.com. I mean, you're going to want to see this because it talks about, I take it to Seinfeld and I take it to Izzy Mandelbaum. You remember Lloyd Bridges as the 80-year-old trainer that's going to get Jerry into shape. Okay, taking it up a notch. Let's go, Cupcake. It's go time. All right. Well, taking it up a notch applies to this idea of a BRICS currency. There's meetings going on about this right now, and there's meetings taking place in the Asian nations, the ASEAN, Asian Trade Group nations, about doing something similar and joining this BRICS thing. All right, which would be 40% this BRICS currency backed by gold, 30% backed by the Chinese renminbi, 10% by the Indian rupee. It includes Brazil, South Africa, Russia, obviously. I mean, just it's very broad already. And when you see what happened this week also, Hungary, Orban, the PM of Hungary, is pro-Russian, all right? Hungary relies for 100% of their energy on Russia, and they've always been a fear that Hungary would look to leave NATO at some point. Well, Hungary and the Czech Republic got together with the far-right faction of the Austrian government, which is pretty powerful, almost neo-Nazi-like to whatever degree, and they are now basically kind of supporting Russia. I mean, you have Orban went to meet Putin, which upset the EU big time. All right, don't forget, I mean, Hungary is a member of NATO. And then went to meet Xi. After Xi and Putin both went to North Korea to meet with the leader of North Korea. So, I mean, do we not see what's happening here? All right, the BRICS currency would be a big risk to the dollar. And what's happened is Chinese have sold over $100 billion of the U.S. securities that they hold. They used to be the largest holder. They aren't anymore. Japan is now. And they bought gold. They now have almost as much gold in reserve as the U.S. does. They have bought 1,500 tons of gold in the last 29 months. And now they're around 6,000 tons in total. U.S. has the largest hoard of gold at over 8,000 tons. Why does all this matter? Because it's so bullish for gold. And gold broke out this week. Silver's on the verge. And it used to be, can silver get to 50? Now it's like, how fast is silver going to get to 50? Because they think it's going to happen pretty fast. A lot of this in terms of all the mining shares, my favorite picks, I'll give you Pan American Silver. PAAS is the top silver pick right now. Newmont Mining has come into its own, and I have been talking about that too. When the big caps that have underperformed come into play, that's going to be your next level of exuberance in the precious metals. And here's my final point. Gold closes above 2336 this month, end of July. It'll mark the first time in history of gold trading since 1971, when they went off the gold standard, that gold has risen for 6 consecutive months. And if you do the math and equate this to a move that we saw from 1999 to 2011, the reason being we compare this because in 1999, central banks got together and said, we're going to stop selling gold. Remember the BOE dumped all their gold? The Swiss National Bank dumped all their gold? Well, they said, we're going to stop selling gold. Well, now central banks are buying more gold than ever the last 2 years. And if you get a similar move, just simple math, the upside target for gold in the next 10 years is $4,900. I'm not saying it's going there now. It's not going to happen quickly. I'm just saying it's doubled in yen terms since 2021. Think about that. Get my special because I look at gold in every pertinent currency as it applies to the BRICS, the G7, and all the commodity-producing countries. You're going to want to see it. So keep track of us. I am at Weldon Live on X. We also have at Money_podcast on X. I'm on YouTube as Gregory_Weldon. Don't forget to check out Facebook, where we're on as Money Markets and New Age Investing. And shoot me an email if you want to get my metals, precious metals, dollar, BRICS currency special. Greg Weldon at Weldon Online.